Alrighty, everyone. So welcome to chapter 3. We're excited to have you on here tonight. We're going to run through this. Remember, we're going to give you every tool, resource it takes for you to become successful, pass this exam within the next 2 weeks. As I run through this chapter, I encourage you that you take notes, cameras on. This is going to be an interactive course. And for the sake of compliance, just understand that this stuff, we're going to run through this very fast. And I am going to touch on bases on the stuff that's important to you to pass the exam. You do not need everything on this in this chapter to be an expert in our field. This information is designed to make sure you know how to pass an exam, okay? So let's talk about chapter 3. We're going to be talking about policy riders, provisions, options, and exclusions. If this hasn't already talked about what those are, let's go through the terms that we're going to need to know. Let's talk about the word assignment. Assignment means transfer of ownership. We're going to go into detail about what that means. It means you're transferring the ownership of your policy to someone else or through to a third party. Consideration, something of value that each party gives to each other. And again, it says binding contract. That's going to go back to the word unilateral, where it's a one-sided party contract. You guys remember that in the previous chapter. Indemnity, a principle that reimburses on which insurance is based in the event of loss, and insurer reimburses the insured or beneficiaries of loss. Lump sum, we talked about that last night. It's a payment in which you'll receive full payment for everything you're doing, right? Minor, a person under legal age. And the NAIC, National Association of Insurance Commissioners, an organization composed of insurance commissioners from all states, jurisdictions formed to resolve insurance regulatory issues. Principal, the face value of the policy, the amount invested before earnings. Okay. Those are key words we're going to hear. So let's actually talk about what does this stuff mean. So a provision. While there's no standard policy in life insurance, the standard policy provisions adopted by the NAIC create uniformity among life insurance policies, okay? So let me give you the reality of real world. When you get an insurance contract and when your policy is delivered to you, there's always a glossary section. And it gives you all these terms and conditions. And right now we're about to go through all those terms and conditions. Definitions of a policy, right? So first one, you're absolutely going to need to know this. I want you to write the word entire contract. What is the entire contract? Is when your policy is delivered to you, it's going to contain your policy, the copy of the original application, plus any writers or amendments. So when someone says, well, when I deliver my policy and I open it up, that no one ever reads, no one ever picks open their policy and reads it, right? The only thing that's in there, Nancy, is your policy, copy of the application, writers, and a writer is nothing more than an add-on to your policy. And I want to give you something. Generally, most of the time, there's an add-on to a policy. It costs more money. And amendments, those are, let's just say you submit a policy and they come back rated. You have to get an amendment signed, which is say, hey, your policy that we originally wrote is not the same as it was. Sign this for disclosures. Sign this for your acknowledgement. Okay, so right here, just like I said, know this. Entire contract is policy plus copy of application plus any writers or amendments. The insuring clause. This is a basic agreement between the insured and the insurer that states that they promise to pay the death benefit. That's all I need you to write. Write insuring clause. Promise, insurance company promise to pay the death benefit. That's the only definition you need to know. Insuring clause, the insurance company promises to pay the death benefit. Now, we're going to talk about the free look provision. free look provision. This is when you deliver the policy, you have X amount of days to look at the policy, and it's free. And the state of Florida, it is 14 days. If you're watching this in another state, your free look provision could be a different amount of days. So make a note of that. As we're going through this, don't listen to this for 14 days if you're in a different state. Go to your state and say, okay, this state is 10 days, or this state is whatever days. Make sure you know your state. So free look provision is pretty much said, hey, listen, you deliver the policy to me. I look at it for 2 weeks. If I don't want it, I'm gonna send it back and I want my full refund. So you get to look at the policy for 14 days. If you don't want it, send it back for full refund. Now, consideration. This is when both parties bring something of value. This is generally when as long as the insured or policy owner pays the premiums, the insurance company promised to pay the death benefit. That is not to be confused with the insuring clause. Consideration is more on the fact of the policy owner is going to pay their portion, pay their premiums. Ownership rights. Now, again, I want to bring somebody to Tatiana, if you could come on live with me here, because we talked about this the other night. Ownership rights. The owner has the rights to do what?
Do anything with the policy, like change anything.
They can change what about the policy, though, in detail?
They can what? I'm sorry?
They can change what about the policy?
They can change the benefits, not the benefits, the beneficiary. They can change the writers. Those basically.
Okay, perfect.
So that's about it.
Well, the policy owner, the ownership rights, they have the rights to change the beneficiaries. They can change the coverage amount. They can change the premium amount. They can say, hey, listen, I don't want the policy. I want to cancel it. They have the right to do anything. And remember, the owner doesn't have to always be the insured. And we're going to go into some of those details, which is right here. Assignments. We're going to cover assignments. Assignments is a transfer of ownership. So I want you to write assignment means transfer of ownership. Now there's two types of assignments. The first one is absolutes. This is where you're going to transfer all rights away. It's permanent. You can't go back and change it. And the second one would be collateral. I want you to write temporary on that one. It's where you are signing a portion of your policy away for a period of time. Well, you might be asking, well, who and what situation would this ever happen? Well, I'll cover absolute assignment. And some insurance policies, there's what is called a terminal illness rider, that if someone becomes terminally ill, they have the option to get a portion of their money advanced to them. And you enter what is called a Viatical Settlement. I'm going to cover that in detail here in a little bit, so don't worry about this too much. But a Viatical Settlement is a third-party company. They say, listen, you're going to pass away in X amount of days or months. Why don't you sell us your policy? We'll give you a portion of the money now. And then when you pass away, they're going to collect the remainder of the money. Sounds like a very crude business to be in, but I guess there's a business out there. So example, you have a $100,000 life insurance policy. You enter an absolute assignment. Maybe you sell your policy for $60,000. That means on the back end, God forbid, when you pass away, they're going to profit $40,000. Does that make sense? The next one is collateral assignment. I want you to write debt or mortgage next to that. Absolute was permanent, all rights, transfer of all ownership. Collateral, I want you to write partial ownership, temporary, debt. Because that's generally when you're going to use it. Use it as collateral for a loan. All right. So the next one, beneficiary designation. We kind of talked about this earlier. The owner of the policy has every right to change the beneficiary at any time. So let's just say you're married. Nancy, are you married?
Which Nancy are you talking
The
to?
one that's got their camera on you.
Okay, yes.
You're married.
Yes.
And let's just say you name your husband as your beneficiary because you love him. Hey, God forbid something happens, such and such. But let's just say something never happens. You say, hey, listen, I don't like you this much. I'm going to change my beneficiary to be my kids. If you ever leave your money to your kids in the state, in most states, they can't touch the money until they're 18 years old. So you need to write that down. Make sure you know that beneficiaries, minors cannot get the money until they're 18 years old. Sometimes the beneficiaries' money could be transferred to the minor's guardian or trustee, as long as that's in writing, right? So let's talk about class designation. This is right here is not going to be that big of a deal on the test, but for the sake of this, I want to make sure we read it. A class of beneficiary is using designations such as my children. The term is vague if the insured has been married more than once, as has an adopted child, as adopted children, or the children out of wedlock. An example of a class that is less vague, children of the union of Jane and James Smith. Many insurers encourage the insured name all the children specifically and state the percentage of benefits that they will receive. That happens when we're writing policies, guys. You want to make sure that you actually write down every specific child. Because if you put all children equally, well, they're going to split all that money between all them kids. And what if there's a kid that they don't like no more? They said, no, we don't like that kid. We ain't gonna get none. Not saying that you, Tati, not saying your kids are gonna be those people, but maybe it's your man Josh. We don't want to leave him no money. Hopefully he can hear me in the background. So let's talk about this, guys. I'm going to bypass this part where it says per capita, per this right here. This is not that big of a deal on the exam. You can come back and read this. But I do want to talk about the three types of beneficiaries: primary, contingent, and Ellie, what was the third one? Because you know I got a problem saying that word.
The third one is what? Tertiary?
Tertiary, that's right. If you listen to myself, I'm gonna say tertiary. I forgot how you say it. So primary, when you write an application, you're gonna put it in basis of primary. If God forbid this person passed away, these are the individuals that gets the money. Now contingent, or that word that Ellie said, would honestly kind of be like your third beneficiary. The only way that these individuals would receive the money is if the primary passed prior to the insured dying. So if the primary passed away before the insured died, then the money is going to go to the contingent beneficiaries. Does that make sense?
Do they have to be listed in their application to be contingent beneficiary?
Absolutely. If they're going to get the money, they have to be listed. And if someone is not listed and they don't have someone on there, it's going to be based off of the state or the court to find out who gets that money. And I don't know about you, I don't trust no government. So I'm gonna have everything in writing, right? So let me see. This actually is a really good video. I want to play this video because this is going to explain something very good right here.
Tom has a life insurance policy in which he names his wife Susie as the primary beneficiary and his son as the contingent beneficiary. If Tom and Susie got killed in the same car accident, the death proceeds from the life insurance policy would be payable to the named contingent beneficiary, since the primary beneficiary is no longer living and able to receive the death benefit.
Poor Bob. Always a Bob. So let's go here, guys. Any questions on beneficiaries? All right. If no beneficiary is named, proceeds go to the insured estate. Sometimes you'll hear that their closest living relative. I want to talk about revocable versus irrevocable beneficiary. So write this down. Beneficiaries, revocable and irrevocable. Revocable beneficiaries. This is when the policy owner can change the beneficiary at any time. They say, hey, listen, I don't like you no more. We're going to change the beneficiary. Now, irrevocable. You can't change the beneficiary unless you have the beneficiary's written permission. I don't know a situation where that would actually be beneficial for the policy owner. You imagine that? Imagine you write somebody as a beneficiary and say, hey, bro, I don't like you no more. I want to change this. They say, nah, bro, you ain't got my permission to change that. You can't do that. I don't know when that would come into place, but obviously I think it could. That's all you need to know about irrevocable versus revocable. Revocable is designation can be changed at any time by the policy owner. Irrevocable is designation cannot be changed without written permission from the beneficiary. Now let's talk about this. It's something called common disaster clause. So give you an example. This is an easy test question you can get right. If the insured and the primary die at the same time from a common accident, and there's no clear evidence of who died first, they're going to automatically assume that the primary died first. So the money's going to automatically go to the contingent. So if they can't figure out who died first, they're going to automatically choose for that. They're going to say that the primary died first. So let's read what the common disaster clause. The common disaster clause, when added to the policy, provides that if the insured and primary died in a common accident, even if the beneficiary outlived the insured by a specific number of days, it is presumed that the primary died first, so the proceeds will be paid to the contingent beneficiary of the insured estate. If no contingent beneficiary is designated, most insurers specify that a certain period of days, usually 14 to 30, in which the primary's death must occur in order for that primary disaster clause to apply. That's not really something that's going to be testable. You might want to write 14 to 30 days on there just to have it as a mental note, but that's really not something you're going to focus on too much. Now let's go to what is called, I want you to write the word frequency on your exam or on your paper. Frequency. This is going to be what is called your premium. How do you pay your premiums for a policy? Frequency is going to determine what is called the premium mode. Next to frequency, write premium mode. There's generally 4 ways you can pay your premiums: monthly, quarterly, every 6 months, which is semi-annually, and then annually. So you want to write that down. Premium mode is another word for frequency. You'll see that on the exam. And again, you can pay for it monthly, quarterly, semi-annually, or annually. So let's go here. Let's go through the word level versus flexible premium. Okay, hold on. There's something I missed over here. It says if an insured dies during a period of time which premium has been paid, the insurer will receive a refund for unearned premium. So if you've paid premium and God forbid you pass away in between that time, your family's going to get a refund of whatever you paid. A portion of a refund of what you would have paid. It would have been, what's that word? Prorated. Leveled versus flexible. Most life insurance policies have level premium, which means the premium remains the same throughout the duration of the contract. Flexible premium allows the policy owner to increase or decrease their policy at any time. So if you see, hey, this policy is leveled, we know the policy is going to stay the same throughout the time. If it's flexible, well, we know the premium is going to go up, and you can go up or down at any time. I want you to write grace period. Grace period, 30 or 31 days. I want you to write that down. Grace period in simple words is that if you miss a payment, you are still covered for 30 or 31 days once your policy has lapsed.
Is this only for Florida or?
No, this is all life insurance premiums. I'll let you know if it's anything specific to Florida. No, this is universal. Grace period, it will protect the policy owner that if you intentionally lapse your policy due to non-payment, it'll protect you that you're still protected during that period of time, which is really good. Let's talk about reinstatement. Reinstatement is when a policy has lapsed, they missed the payment, and you want to get the policy back in force. It is, for the most part, always better to reinstate a policy versus writing a new one for the client, because you can lock in, you can go back to their original premium, because there could always be an age change if a policy lapses. So policy that lapses, you're allowed to reinstate the policy. Now you have 3 years to do that. You have up to 3 years to reinstate your policy. But there's 3 things you have to do in order to reinstate your policy. So I want you to write this down, like 3 things, and then write 3 bullet points. The first one is you must pay back any premiums. Pay back all premiums plus interest. So in order to reinstate it, you have to pay back all premiums plus interest. If you have any loans, you have to pay outstanding loans and interest on the policy. Again, that'll only apply to whole life policies. Pay back all loans. And you must provide proof of insurability. So third one is provide proof of insurability, which essentially is, hey, I got to ask you these medical questions. Has anything changed in your health? And if nothing's changed, then we're good to go. Now, let's talk about any questions on this so far. No? So let's talk about this. If you reinstate a policy, or I'm going to cover something, I want you to write this down and like some little note next to reinstatement. If a policy has been surrendered, and that's going to come out of the cash value, if a policy has been surrendered, it cannot be reinstated. So whole life, if surrendered, cannot be reinstated. The next one is called Incontestability clause. This is a big, big deal. The incontestability clause prevents an insurer from denying a claim on an application after the policy has been in place for 2 years. So I'll give you an example. If someone lies on their application about being a non-smoker, let's just say they're a smoker, and they say, hey, I'm not a smoker, and you can't prove it, you haven't seen a cigarette, you haven't seen any of the type of stuff, so you write their policy as a non-tobacco user. If they die in the first 2 years, and the insurance company will do an investigation, if they can prove that you lied on your application, that policy will be voided and the family will get nothing. If you lie on the application about your health and they find out you lied, your family will get nothing. If you somehow do misleading stuff and again, you pass away, and they can prove it. Now, here's the way after that. If you die on year 2 years and day 1, and you said you were a non-smoker, but you were a smoker and you died on day 1 after 2 years, they cannot deny that claim. So you have a 2-year waiting period called the incontestability period. You need to know that like the back of your hand, because that is what you're going to use that in the field. You'll have sometimes people will ask you, well, is there any reason why this policy wouldn't pay out? And that's something you need to know. Okay, so misstatement of age or gender. Now, you know, we're in 2023 these days. That'll get you canceled. Hashtag woke culture. Hashtag cancel. Anybody got time for all that anyways. So misstatement or age or gender. In the insurance world, guess what? Guess what they're going to go by? They're going to go based off of your biological sex, your biological gender. That ain't what you feel like today. It's, hey, listen, this is what you are. If you say on your policy, hey, because they can always go back and adjust your coverage and your death benefit if you lie about your age or your gender. I'll give you an example. Let's just say you're a 45-year-old male, but you say you're 35. Well, guess what? You're lying by 10 years. I'm sorry, hello? Okay. So if someone says they're 45 and they say they're 35, and they go back and they look at the policy and say, hey, listen, we looked at your death certificate, this is wrong. They're going to go back and adjust your death benefit based off of the premiums you paid that could afford. So you don't want to lie about your age, don't lie about your gender. They will find that. Okay, next thing is let's talk about policy loans and withdrawals. So, and again, whole life cash value policies, we covered this in real detail last night. Whole life policies. If you borrow money from the policy, they have up to 6 months to give you that money. Remember, this is your money sitting in this savings account and this cash value policy. The insurance company has to give you written notice about that, and they have up to 6 months to give you that money. I don't know about you. I don't want to wait 6 months. If it's my money, I need it, right? So that's what you need to know about policy loans. So if you see right here, policy loans are only available to policies in the policy that have cash value, whole life. Automatic premium loans. We're going to take just a second to talk about this, okay? You have a whole life policy. You have some money sitting in the cash value. And let's just say you accidentally forgot to make a payment. They will take a portion of the premium, or they'll take your premium out of your cash value to pay your premium. So that'll keep your policy in place. But it ain't free. Automatic premium loans. So they're going to charge you interest to take your own money out of your account to pay your premium. And you got to pay the insurance company interest just to do that for you. How's that sound? Congratulations. Welcome to Whole Life, guys. And again, if you want to borrow this money at any point, the insurance company can defer your request up to 6 months to get that money. Okay, that's all we need to know about provisions. So all that right there was provisions. And the word provision just means rights and obligations. If you don't have that on the top of your sheet of paper, write provisions, rights, and obligations. These are your rights to the policies, and these are your obligations to keep the policy going. Now, let's talk about exclusions. Exclusions, and a whole fancy word is, why will this policy not pay out? What is going to stop me from actually getting this money? Well, there's three things we want to look at. Aviation. So most insurance companies will cover an insured for someone that is buying commercial flights. But if you're a non-commercial pilot, let's just say you're a pilot that rides around for fun, that's kind of a dangerous job or dangerous hobby. Would you agree? So they have the right to say, hey, we don't want to insure you for that. So we're not going to cover that. The next one is hazardous occupations or hobbies. If the insured engages in hazardous occupations or hazardous hobbies, such as skydiving, racing, auto racing, death that results in a hazardous accident may be excluded from coverage. So you always want to be honest, but hey, listen, they have the option to say, hey, we won't pay out if this happens. And the underwriter also has the option to charging you higher premiums for that. The more risk you take, the more money you're going to have to pay. The next one is war or military service. It says most life insurance policies do not exclude military service. However, there are actually two types of exclusions that may be used to limit the death benefit if the insured dies as a result of war while serving in the military. The status clause excludes all death while the insured is on active duty in the military. The result clause only excludes the death benefit if the insured is killed as a result of war. Let me ask you a question, Nancy Guzman. If you pay for a policy and God forbid you had to go to war and that policy didn't pay it, would that be a policy worth keeping? Or that was, no. The big thing that you want to look out for when you're selling insurance is, why was this policy not pay out? The company that we work for, we don't have that. Doesn't matter how anyone passes away, your family will get that money. It doesn't matter if it's in 9/11, doesn't matter if it was, God forbid, any war or terrorist attack, your family is going to get that money. That's a big deal. Let's talk about suicide. When you put suicide, I want you to write the word 2 years. Kind of back to that incontestability period. If someone, God forbid, commits suicide within the first 2 years of purchasing their policy, the family won't get the money. So after 2 years, it doesn't matter what happened, the family's going to get the money. If they commit suicide within the first 2 years, the beneficiary can get a refund of all the premiums they paid. So that's a big one. Those are all you need to know about exclusions of reasons a policy won't pay out. Now, I want you to go to a separate part of your page. I want you to write policy riders. These ones are about to get pretty heavy right here. They're simple, but there's just a lot of them. Policy riders. Riders, these are modifications that are add-ons. Again, add-ons are generally more money, okay? So let's look at disability rider. Some of these riders provide benefits, and if the person becomes disabled, like there's companies that sell supplemental insurance policies. If you've ever heard of this duck, Aflac, if you've ever heard of that duck, they sell a lot of the disability supplemental policies. They actually do have some benefit to it. There are certain policies that offer these, but disability riders, you're not going to see a lot of that on the exam, but it is something good for you to know that some riders provide benefits of the insured's disability, while other riders provide partial payments of the death benefit prior to the insured, called accelerated or living benefits. We're going to cover that in a second. All right, waiver of premium. I want you to write 100% disabled. I want you to write waiting period of 6 months. And then I want you to write policies free. So you must be disabled for 6 months. On the 7th month, they will reimburse you your last 6 months. They will give you a refund of your last 6 months. Write that down. After 6 months, if someone is totally disabled, they will refund you the last 6 months of your premiums. And then your policy is free until you can go back to work. And if you can never go back to work, your premiums are paid. That's all you need to know about waiver of premium. Just to clarify, 6 month waiting period, totally disabled, reimbursement of your policy after 6 months if you're still disabled. Then your policy is free. Let's see this. I don't know if I've ever seen this on the exam, but let's just cover it. Waiver of monthly deductions. The waiver of monthly deduction rider pays all monthly deductions while the insured is disabled. After 6 months waiting period, the rider only pays monthly deductions and not full premium necessary. The length of time of the rider will pay monthly deductions will vary based on the age of the insured. This rider is usually found in universal life, variable life. So in this example, they're saying the waiver of premium won't cover everything in these policies right here. Let's talk about disability income. Disability income occurs that if you get into an accident or you become disabled, that they will pay you monthly payments of your income. Again, this is more supplemental policies that people will have, but I assume that there's got to be some life insurance policies that have these as riders. That if you become disabled, they will give you monthly payments. That's not to be confused with waiver of premium. Disability income rider will pay you monthly payments. Any questions? Am I moving too fast? Are we good here? Moving at a good pace? Okay. The next one, I want you to put payer benefit rider. Payer benefit rider. And then next to that, I want you to put for children, for minors. This one says that if the guardian or the parent becomes disabled after 6 months, or if they pass away, the child's policy is automatically paid up until they're 21. I'll repeat that again. This is a rider as a payer benefit that if the client, the guardian or the parent is disabled for 6 months or longer still, they die, the child's policy is paid up until they're 21. They're disabled after 6 months, or they die. Their child's policy is paid up until 21. All right, so the next one is other insured. So you're going to see other ways of how people add on to the policies. We just need to know these terminologies. The other insured provides coverage for one or more family members. So the other insured provides coverage for one or more families members. The spouse rider is you have your policy and you're going to add your spouse to your policy, and now they are a rider to your policy. They are an add-on to your policy. And then you have what is called your children's term rider, your child rider. The child rider is you can add any child, adopted, stepchild, natural birth to the policy as long as you take care of them in some facet. And again, this is the term policy. So this will generally take the kids up to 21 or 25, depending on the company. Right here it says 18 to 21. Okay, so ignore the word 25. That's just our company. We're just a bomb-ass company like that. We go beyond that. So 18 to 21. That right there, Nancy, is universal. Doesn't matter the state. That's universal right there. The good thing about a child rider, Nancy, is you pay for one child. It covers all of them. So imagine Nick Cannon right now. He's probably got one child rider covering all his daggum 12 kids.
Does the kids have to be included in the application or just one?
Well, you're going to list them all, obviously. You need to list them for sure. Again, everything needs to be in writing when it comes to insurance. Okay, so the family term rider incorporates spouses, children riders, and when you have one big policy that has the primary, the spouse, the children, it's called a family term. It's called a family policy. Okay, so I want you to move to a new page right now, because this right here is, I want to keep these things together. There are riders that you can double or triple the amount of benefit based off of how you die. So there is something called accidental death and dismemberment rider. This way, you have to die within 90 days of the accident. Okay. You have to die as a result of the accident, not as, hey, we get to an accident and then you go to the hospital and you die of pneumonia. You didn't die of the accident. The accident had to be the reason you died. This is a rider added on, but actually a lot of banks sell these. If you ever come across clients and say, people, oh yeah, I got my insurance through my bank, they're generally paying a couple dollars a month for this. And they say, oh yeah, I got $150,000 of coverage. This is not life insurance. Accidental death and dismemberment is not life insurance. It pays out in the event of death, but is not to be mistaken for actual life insurance. Because let me ask you a question, Nancy. You're up in New York, right?
Yes.
What are two intersections that do not cross?
I do not know.
I mean, what's two streets in your state or your city that they don't even intersect?
I do not know.
Okay, Tatiana. So the chances of this kind of policy paying out, I really want to give you the example, because they have what is called double and triple indemnity. Well, they'll even pay out double or triple the amount if you die in an accident. But you must lose two of the identical limb. And what's the chances of that happening? Okay, so you got to go die in an accident. And so if you live in Jacksonville, does Atlantic and Blanding, do they merge? Do they intersect at all? So the chances of this policy paying out is the chances of Atlantic and Blanding merging. You got to die on that intersection, and you got to lose 2 thumbs. What's the chance of that happening? You have to lose both legs. You can't lose a leg and an arm. You have to lose 2 of the identical limbs. And I tell you this, and I'm going in on this crap because it's a crappy ass product that people sell. But let me get off my stool. That's just what it is. I'm just giving you the reality. That's how it works. The next one, guaranteed insurability. Guaranteed insurability allows the clients, this is the writer. I'm going to give you the bullet points for this. It allows the client to increase their coverage at future dates. And these are the examples. It's generally every 3 years. And that's for such as marriage and birth of a child. So guaranteed insurability allows you to increase coverage without any evidence of insurability. So you don't have to go through any medical questions. So if husband and wife, they get married, they have a kid 3 years later, they can increase their coverage automatically. It can't be husband and wife get married, they go buy a house 3 years later. You can't buy a house and consider that a reason to increase your coverage based off this writer. That is a question you'll see. This is which of the following would be a reason that guaranteed insurability rider would kick in. And if you say click on a house, this is the wrong answer. Any questions on that? All right. Let's talk about return of premium rider. We talked about return of premium was a type of term insurance that we talked about 2 nights, chapter 1 or chapter 2. Return of premium rider, Nancy, it's a rider that you can add on. So let's just say you have a 30-year policy and you add this rider on, it's an extra cost. And if you don't pass away at the end of the 30 years, they'll say, hey, we're going to give you all your money back. That sounds pretty good, right? But what if I told you they charge you almost up to 50% extra? Is that a good deal? No. Because what do the insurance companies do with those extra premiums? They reinvest that. They're going to get a higher rate of return. And they'll say, of course, we'll give you a little, we'll give you a few $1,000s back because we invested the rest of that money, made money over the last 30 years off you. That's what you need to know about return of premium. Okay, this right here is when I was talking about the accelerated death benefit, the terminal illness rider. So this is what is called accelerated living benefit. You must become terminally ill. Let me cover the details on this, guys. In order to receive early payout of your policy, you must be terminally ill. For the case of that, some people call it 6 months or less to live. I don't know the textbook definition of that, but terminally ill means, hey, unfortunately, you can get a portion of this money advanced to you, or you're selling your policy to somebody else. Depending on the company you're representing, depending on the company that is writing your policy, of how that works. So let's talk about how does that go into effect. Where's the terminal illness rider? Okay, I guess Viatical Settlement is later in this chapter, but right next to accelerated death benefit, I want you to write Viatical Settlement, because we're gonna touch base on that either later in this chapter or in another chapter. All righty, guys, we're on the home stretch here. We're almost done with this chapter. Let's just see.
Sorry, can you repeat it? What you say for accelerated benefit by what?
Viatical Settlement.
Viatical.
Viatical. If you don't know what it is right now, don't worry, I'm going to get to it. Viatical settlement. Obviously, there's long-term care. You're rarely going to see a long-term care question on there. If you want to come back and read that, go ahead. Okay, this is another one. Policy options. Okay, we're gonna go through. Just trying to see what's all in here. Okay, so we only have a couple things we need to talk about policy options. Okay, so policy options. You're gonna write down non-forfeiture options. This word right here, non-forfeiture options. And what you're going to write next to that is you're going to write whole life cash value. These are the options you have to use the money. So that money sitting in the savings accounts, if you don't use it, like if you don't pull from it, you do have other options to use it to buy more insurance. So non-forfeiture options, right? Whole life cash value. And those guarantees, so these are guarantees in a policy that cannot be forfeited by the policy owner. So we're going to give you an acronym. The acronym is going to be REC. So write down the R is going to, I got to come out of order here. The R is going to be for reduced paid up addition insurance, or reduced paid up insurance. The definition of this is you're going to take whatever money is sitting in that whole life policy, the cash value, and you're going to take that money and you're going to buy a paid up policy. You say, hey, listen, I'm done paying on the coverage. I want to take this money and I want to buy a reduced policy. Say, hey, I'm done paying on it. I want to buy a reduced policy. Now that new policy will still continue to build cash value. So it's reduced paid up is the R. E stands for extended term. This one, you're going to write the automatic option next to that. Extended term, automatic option. So this one is, I'll kind of read it for you. It says the insurer uses the policy's cash value to convert to a term policy of the same face amount as the permanent policy. But now you're going to extend the life of the policy. So you're taking the same money that's sitting in the cash value, but now you're buying a term coverage because whole life is permanent. You're going to use that cash value to buy a term policy that's going to extend the life of your coverage. Now, let me give you the reality of this. It says if the policy owner has neglected to select one of these options, the insurer will automatically implement the extended term option in the event of a termination of the original policy. So if you don't choose something, what to do with it, they're going to automatically take that money and buy you coverage. The name of the game for insurance companies is keep the money in-house. They want to keep as much of your money in-house in their pockets, okay? And the C stands for cash surrender. I want you to write the word cash surrender. Do you remember earlier when I talked about reinstatements? If you surrender the policy, you cannot reinstate it. You guys remember that? Mm-hmm. This is what this refers to. If you say, hey, listen, I have my insurance, I have my cash. You say, listen, I don't want this insurance policy no more. I want to cash out of it. I want to take the money and I want to leave. They will do that, but you can never reinstate that original policy. And there is what is called a surrender charge. Imagine you buy an insurance policy and you're putting money into this policy for a couple of years, and you've accumulated a little bit of money, and you say, hey, listen, I don't want this policy no more. I want to take my money and leave. But they say, yeah, you can take your money, but we're going to charge you this. So you're really left with that. Is that a good vehicle or no? This is what's being sold out there. When you break down this stuff to the basics, people don't read this crap. Okay. I'm going to cover dividends now. I do not want you to get these acronyms confused, but dividends, the definition of a dividend in insurance is a return of excess premium. So dividend, return of excess premium. What does that mean? The insurance company says, hey, Nancy, your premium is $1,200 for the year. And at the end of the year, they go through their numbers and they found out it only actually costs you $1,000 to cover you. So you have $200 extra that they overcharged you. And we're going to give it back to you. Does that sound good? That sounds good. But it is deceiving when you hear companies do this. There's a company out there, for compliance reasons, I'm not going to say it, but they will say, we are the #1 insurance companies when it comes to paying dividends. They are publicly telling you, hey, we're known as being the #1 company to overcharge you and give your money back. Publicly out there. So let's talk about the dividends. What is, okay, a dividend in insurance is not taxable. When they give you a refund of your money, it's not taxable. If you've ever had investments, if you invest into what is called like a blue chip company, every quarter they generally will pay you a dividend. If an investment company pays you a dividend, that means they made profit. Now you owe taxes on that. And insurance, no. Insurance is a crooked ass world, and they try to use the same words to make it sound fancy for you. So the acronym we're going to write down is called CRAPO. So you're going to write it down. CRAPPO. CRAPO. Like all these policies are a piece of crap. Yeah. So C stands for cash. You probably guys are like, what the hell? Why is it going off on this tangent? It's because when you sit down with these clients and you're like, you guys are getting ripped off, you get fired about it. So cash. Cash simply says, Nancy, we overcharged you by $200. Here's your money. You can take it. The second one is reduction of premium. Next to reduction of premium, I want you to write reduce next year's premium. Reduce next year's premium. Because all you're simply doing is, Nancy, you say, hey, listen, I don't really need that extra $200. Why don't you just put that towards my next year's payment? So reduction of premium is put towards next year's premium. Now, for you that were on training last night, when I kept saying accumulation at interest for the one acronym, remember that, Ellie? Messing up. This right here, accumulation at interest is what A is. Anytime you earn interest, you owe taxes on that. Your government wants their money. So your government's going to say, anytime you earn interest, give me the money. And next to this, I want you to write temporary option. This right here, you're essentially saying, hey, listen, I don't really need the money, invest it. And whatever the interest is, add it onto my death benefit. Now let's talk about this.
You said for accumulation was temporary, right?
Correct. Because you don't always have to keep it that way. There's another temporary option I'm going to come into. So the fourth one is paid up addition. This one is where they're going to take the money and just buy a single premium additional of insurance. So they're going to take whatever that $200 that you would get and buy you some additional coverage. And next to this, I want you to write the automatic option. Just like in the non-forfeiture options, they say, hey, if you don't tell us what to do with it, we're going to automatically use this to buy you more money, buy you more coverage. What's the name of the game? Keep the money in-house, right? So that's the automatic option. The other P is called paid up option. So this one says usually the insurer first accumulates the dividend at interest, then uses the accumulated dividends plus the interest and the policy's cash value to pay the policy up. So you're essentially using your dividends, your interest that you've earned, the cash value to hopefully pay your policy up so you don't have to make any more payments. So paid up option. And then the last one of that is called 1 year term, which is simply says, hey, you're going to buy a 1 year term policy. For whatever that dividend would buy me, buy me a 1 year term. Any questions on this? No? We're good? All right, we're coming down the stretch, guys. The next and the last acronym I've got for you is called settlement options. Settlement options, this is the way that you will receive the money from an insurance policy or from an annuity. So settlement options. I want you to write the word cliff. Didn't we talk about this last night? Didn't we write this? Okay, so we're getting a review. So cliff, CLIFF. If you guys don't automatically know what C is going to be, it's going to be for cash. Kind of figure that out. L is going to stand for life income. And next to life income, I want you to write the highest amount of money paid out. So when someone chooses a settlement option and they say, I want to get the most amount of money monthly, there's going to be life income. Now, Nancy, the way that works is, let's just say someone chooses to receive this money for the rest of their life. The moment they pass away, their family's not entitled to the money anymore. They forfeited that to the insurance company. So the insurance company will guarantee them money for life, which sounds great for the person, but when the family ain't got nothing left, good luck. But there is something called with period certain. So I want you to write life income with period certain. So essentially, if someone has a life income with period certain for, let's call it 10 years, and that person dies on year 2, the beneficiary would receive money for at least the remainder 8 years. Does that make sense? The other one is interest only. Next to that, you're going to write temporary option again. This one, you don't know what you want to do with the money yet. So you're just going to say, hey, pay me the benefit, pay me the interest on the account. Now, what happens when you earn interest? What do you have to do?
Pay taxes.
Correct. Good. That's going to be a common question on that. Yes. So interest only is temporary option. They're going to pay you the interest. The last two, fixed period. This is when you will receive a specified, you will receive money for a specified number of years until it runs out. And then fixed amount, you're going to say, hey, I want X amount of dollars paid out to me, and it's going to get paid out to you until it runs out. And that, my friends, is all of chapter 3. How y'all feel? Overwhelmed, overloaded? Feel good? If you've read chapter 3 on your own, you should already know that this is not that overwhelming. Just sometimes going for the first time, like, oh, so much information. How you ladies feel about going through a quiz? I got a bunch of yeses, so we're going through a quiz.
That's right. I gotta reread it.
Well, good. Let's go through a quiz real quick. Let's kind of see where we're at.
You wanna do one?
Yes.
I could do one.
Which of the following protects the insured from unintentional lapse due to not premium payment?
Reinstatement.
Reinstatement is once the policy is already lapsed. This is unintentional lapse due to non-payment.
The automatic premium loan.
Wonderful. A, automatic premium loan. Great job, ladies. All right, an insured that has had a life insurance policy that he purchased 3 years ago when he was 40 years old. He was killed in an automobile accident and discovered that he was actually 45, not 43, as stated on the application. What will the company do? We talked about the misstatement of age, huh?
Pay a reduced death benefit.
Aha, pay a reduced death benefit. Absolutely. Good, good, good. Now, I don't know, Ellie, I don't know if that's you. I don't know if that's Jesse in the background, but great job. All right, the insured under $100,000, or the insured under $100,000 policies with triple indemnity for accidental death was killed in a car accident. It was determined that the accident was his fault. The triple indemnity rider specifies that the death must not be contributed by the insured in any manner, in which case will the policy beneficiary receive? Let's go common sense. What's your first, based off of what I told you about that stuff?
I will say C, 100,000.
Okay, well, remember, they can't, the auto accident, they were killed, and the triple indemnity rider. So you're saying they died in an accident still, so they should still get something, right?
Yes.
Okay, let's see what common sense says. Congratulations, you're right. Good job. Items stipulated in a contract that the insurer will not provide coverage for are found in what? It's stipulated that in a contract that the insurer will not provide coverage are found in what?
C,
Huh?
C, exclusions.
The wonderful, great job. I think you ready to pass this exam already, Nancy. All right, what
I
happens?
know.
What happens when a policy is surrendered for its cash value? So you took the money and you ran.
D,
No. Go
B,
back.
yes.
B.
B.
C,
Wonderful, great job. You took the money and run, it cannot be reinstated. Which of the following is not typically excluded from life insurance policies? Death due to plane crash from a fare paying passenger, self-inflicted death, death from occurs while a person is committing a felony, or death due to war or military service. Which are the reasons they would not typically pay out? Come on, Ellie, you got this.
I'm sorry, Al distracted me.
Okay, so where are we at? Come on.
I will say D.
You're saying D?
Yes.
Okay, we're saying B or D. I'm gonna go with A. The answer is A, because generally policies do not exclude fare paying passengers. How crazy is that? You get on the Airlines, and you know when you get on Spirit Airlines, you pray to God anyways. I don't pass away. I don't pass away. I pass away. So yeah, they're not going to deny a claim because you are a fare paying passenger. All right. So which non-forfeiture option provides coverage for the longest period of time? Go back to your non-forfeiture options. Your rec. Which one provides the longest period of time?
Benefit A.
Hey, wonderful. Great job. Hey, what were these payouts?
Oh, bad job. Reduce payout.
Mhm.
Yeah, I
Now
don't know.
I'm confused.
I don't know what the hell they're talking about. That I've seen that question before. Ignore that one. I'm telling you, there's a glitch there. I've seen that question, and I always get that one wrong, but I know it's not right. I'm telling you, that one's extended term. The longest period of time is extended term. We're going to ignore that one. The rider and a whole life policy that allows a company to forego collecting premiums if the insured is disabled.
A.
Congratulations, great job. Which of the following is true about mandatory free look provisions? Free look in a life insurance policy. Mandatory free look. That's when the policy is delivered to you. What is the best answer? Best right answer?
B.
C.
Who said B? Who said C? Is that what you said?
C when it's delivered?
Yes. Absolutely. It is C when it is delivered. What is the purpose of the free look provision or free look period in a policy?
It's a D.
You said D. It
D.
allows the insured to reject the policy for a full refund. I would agree with you. Let's go. Come on, we're doing well, ladies. We're doing good. Non-forfeiture values guarantee which of the following for policy owners? Non-forfeiture values are guaranteed that, I'm gonna let you guys,
Which of the following is true for the policy? It's guaranteed.
she says B, Jade says B. Let's go with Jade's answer, see what she says. Look at that, good job, Jade. Let's go, wonderful. All right. What is the term for how frequently a policy owner is required to pay premiums? We talked about this earlier. I said highlight this one.
B.
B. Mode or frequency. Great job. Great
You got
job. Which of the following settlement options in a life insurance is known as straight life? You're going to receive the money for your straight life.
Their life is level, so that would be like life income? No. Oh, so loud.
Remember, this is going to go based off of CLIF. Acronym for CLIF. It's not fixed period, no. If you didn't write this down, and if I didn't tell you,
Life income.
yes, right next to life income, write straight life. Straight life. No, that's true. It's the highest amount paid out, but it's called straight life also. Okay. Two more questions, ladies. A rider attached to a life insurance policy that provides coverage on the insured's family members is called what? Remember, you got the primary, the spouse, and the children. Huh? What?
I will say
Is
A.
it C?
Wonderful, great job. It is C. Good job, good job.
Nice.
If you're realizing, ladies, this is nothing but definitions. It ain't nothing but daggum memorizing this crap. All right, children riders attached to a whole life policy are usually what type of policy? Anytime a child rider is attached to something, it's always this.
Term.
Term. It is always a term rider. I'm pretty sure young ladies got at least an 80 on this. 93 up in this hole. Let's go. Great job, ladies.
And we're him here thinking that I needed to read it again.
Wonderful. Great job tonight, ladies. Good job to everybody that have successfully made it through chapter 3. I am going to stop streaming this and stop recording.